So we went into this way more in depth than I intended. So here's the takeaways. Hoffman, the first time that you did this, or Burton, the first time that you did this, is it intuitive?
Yep.
It is not. Is it more intuitive now?
Yes.
It's a little bit.
A little bit. How much of this? My sense is you're doing this quite a bit for your real estate guys.
Yep. I do it.
I don't know if you're
I try
doing
to
it
do
as
it
much often or not.
every new client we get or that is set up, that they're setting up a new partnership. I ask them to send me the operating agreement because I look through that first before they even get started. I always request it. I go, hey guys, just let me take a peek through it, see what's in there, and then I want to explain to you what it says based on my knowledge of reading it, what I interpret it to say, and if that's what you want to happen, good.
Any new client, any new partnership agreement, because on Vivacity, how easy is that thing?
Zach did all the hard stuff. I was just, but it looked like a hot mess.
Okay, so that one, I looked at that waterfall in there, I might have thrown up in my mouth. I mean, there was 14 different levels to that waterfall, and that 14 different levels of that waterfall have its own set of rules, and things turn on and off going through that waterfall of who gets what. At 14 levels, my comment to the client when we were on the phone initially was, are you guys going to tell me what the economics are here? If you guys can tell me where we're standing in the waterfall, and if we have $1 of income, where does it go? And if we have $1 of expense, where does it go? We're good. But I'm looking at this waterfall, and I have no clue as to how this works. And then when the first time we worked through it, there was a capital shift, and that surprised them, so they had to rewrite the waterfall, whatever.
Don't forget about the QBI and guaranteed payments, Pete.
Do I?
QBI and guaranteed payments?
Oh. Put a pin in that. Seriously, I'm going to come back to that, because I did not think of that, and that's a really good thing to bring up. Okay, so the things that you should take away is capitalized items or defined items. That could be helpful. The portions of the agreement that I focus in on are income loss, operating distribution, liquidating distribution, tax distribution, 754 and 704. Because 704, what are the three methods, Sam? Traditional.
Traditional, liquid, curative, and remedial.
Okay, and the agreement is going to tell us what that is, and if we're representing the inherent gain partner, which do we want?
Not remedial.
We want traditional, yeah, but clearly not remedial. But if we have the non-inherent gain, we want remedial. Okay, so that's the portion of the agreement that focuses on 754, who makes the election, who has the opportunity to make the election, tax distribution provisions, and this is actually helpful. Tax distribution provisions is going to come in basically kind of two flavors. So, stupid question. If I put $1 million into the partnership, and Aaron, you said if we have a loss, and I'm the only guy, and the loss is getting allocated to me, and my capital goes from $1 million to $400,000 loss, because there's a $600,000 loss. My initial capital was $1 million, went down to 400, right? Because there's a $600,000 loss. I have a $600,000 W-2. We did the loss hurdles. Okay, what are the loss hurdles?
Basis, at-risk basis, passive activity loss, holding.
And excess business loss.
Yep.
Okay. Do the loss hurdles. I'm going to say I have a $500,000 W-2. It offsets. I get to use $500,000 with a $100,000 carry forward. Actually, 605, right? The new limitation. Is that what we said? For married joint?
610.
610. Okay. 610 for the excess business loss. Okay. So now I get a full refund on my W-2. So 600,000 times 30% is 180,000. Just pick a number. I get a $180,000 refund because I have this loss, this $600,000 loss that offset my W-2. Because I jumped every hurdle, I got there, and offset my W-2. Yay me. So the tax distribution provision, now you have to key in on what the tax distribution provision says. Tax distribution provision can say, in general, one of two things. In a year of income, we're going to give you a 40% tax distribution or some number. Or, in the alternative, to the extent that we are allocating income to restore a loss, go pound sand. You've gotten the tax benefit. So let's look at what that means. So if it says simply, in a year of income, we're going to give a tax distribution. If in year 2, I have $600,000 of income, which takes my capital account from $400,000. So year 1 was $1 million, I got a loss of $600. Year 2, I have income of $600, which takes my capital account from $400 back to $1 million. Brad, my starting point in my capital account before anything happened was
$1 million.
And after the year 2 income allocation, my capital account was
$1 million.
$1 million. I'm in the same spot, am I not?
Correct.
Okay, so the capital account is now in the same spot. But in year 1, my W-2 was completely offset by that loss, and I got a $180,000 tax refund. That seems nice. Year 2, I have $600,000 of income. Nobody has a good memory when income's coming back. They love it when losses come your way. They hate it when income comes your way. So now $600,000 of income is coming my way at a 40% tax distribution. What's the math, girl? 40% of 600,000. Melissa?
240.
240. Okay. So if the provision says in a year of income, we're going to give a tax distribution based on the income allocated, I get a $240,000 tax distribution. Even though I've just been restored, Brad, what was my starting point? What was my ending point? Okay. I got the benefit of the loss. Now that loss is being replenished by income. Or in the alternative, it says, if we're replenishing prior losses that you've gotten the benefit for, you get 0. So either you're getting 240 of a tax distribution or you're getting 0. That's one of the reasons why I focus in on the tax distribution and what is the rules of engagement between the partners. So capitalized, these provisions, if you figure out where those are in the agreement and how to run the traps, meaning the agreement we had for Hopping Up said you got to go look at target account. Wasn't that the definition? And we looked at target account pointed us to 27. And then I went off the rails saying, I don't know why I'm in the 27, because 27 meant nothing to me in terms of what we were expecting. I expected 27 to say, we're going to allocate income to make our liquidation provisions true. That's what I expected 27 to say. And being able to run through the agreement and be patient enough, this is where your PD flyer connectors become pretty handy. Because if it says, in the definition, you need to go look at 14.I. All right, I'm going to put a connector here, and then I'm going to go read 14.I, and now I can flip in between those two and connect them to make them meaningful. And then 14I says, well, I got to go to 16J, which is more than possible. Well, now you connect from 14I to 16J back to whatever the other provision was. And you can grab all the pieces of the operating agreement and pick them up and try to put them together. It's not easy. It's not easy to hold it all together. Okay, so the value is, at minimum, recognizing these are the provisions. Targeted income allocation, meaning we're going to allocate income to make your liquidating provisions true, and then knowing that you have to run through the liquidating provisions to find out what those rules are, and then creating the Aaron Hoffman special spreadsheet to have wild swings of income, wild swings of loss, that comply to what these liquidating provisions are. You slide it across the table to the attorney and the client, and either they say, what the hell is that? That's completely wrong. And we can say, well, here's how we interpret the words. And the attorney goes, no, that's not right. Here's what the words mean. Fine. We'll take that. Or the client says, that's not what we intended. Fine. In both cases, we have the opportunity to adjust based on those conversations. That's what all that was meant to encapsulate. And learning how to interact with a operating agreement is that is truly a consulting opportunity. As we sit here and say, the only way you're going to be able to consult is if you know something. Knowing how to do that is really knowing something. Okay, let's see. Brad, who you want to call on?
Nate.
Are you two just going to call each other for the rest of the day?
Yep.
Okay. Nate, what's this say?
Nope. It says a waterfall income allocation is a set of instructions and an operating agreement. The instructions are nonlinear income allocations to partners. Facts: A and B form AV LLC. A contributes $1 million and B contributed nothing. They agree that A will get a 10% preferred return of the 1 million. Once the preferred return, once the preferred return, the income is split 50-50. In year one of operations, AV LLC will generate $300,000 of income.
Okay, so we have a total column, we have a column and a B column. Total column says, what's your first rule? We have a preferred return of $100,000, correct?
Yes.
So we have to harvest out of our $300,000, 100, and then follow the rules of the operating agreement, which says shove that income to A. Okay? Then it says, well, what's remaining? It's 200,000. And then we have to reference what the rules are of the agreement, and the rules of the agreement say that 200,000 is split 50-50. 100 goes to A and 100 goes to B. And now we know A's K1 is 200 and B's K1 is 100, correct?
Yeah.
Now what's really fun, let's reflect on what we did for almost a day. 704C. Tack in that special income allocation on top of this. I hate it. Because this is an agreed upon allocation, isn't it? 704C is a required allocation. And if there's inherent gain property that's on top of this, it sucks. Okay?
Pete.
Contribution of partner to partnership.
Pete.
Yeah.
On that last example.
Yep.
So, our first rule is to allocate the preferred portion of 100,000 to A
Yep.
because it is 10% of his original contribution of $1 million.
Yep. So
After 10 years, he's gonna have $1 million returned to him. So
No.
then,
nope. So now this is a great question because this is where the attorneys, you're thinking like an attorney. Okay? And what happens in Aaron Hoffman's world, which is very inconvenient, not his world, the fact pattern. What happens is he deals a lot with real estate developers. And what happens, Aaron, from a real estate developer perspective, until a year of dissolution, what generally is the income profile of a real estate entity?
What's the income? Rental income?
I know, but in terms of, is it lots of income, break even, or loss?
On a development, it's usually loss, then lots of income with no cash, then income with a little bit of cash, and then income and cash equal.
Okay, so what causes the lots of income with no cash?
The debt.
So
you have gains.
So are you presuming cash out refi?
No. In an actual development, you're selling lots. So you have a portion of, usually the debt's written, so a portion of every sale goes to pay down the debt until the debt's paid off. So you're not getting cash distributions, but you have still gain on the lot sales.
Okay, and what about like residential or commercial real estate?
You typically have losses right away because of depreciation.
And interest and
Interest, yep.
and generally the income event is going to be associated in general more of a cash out, or I mean a sale of the property.
Correct.
Okay, so now back to your comment, Brett, of, well, wait a minute. Let's stick with this and then I'll come back to the real estate. The rule is you're going to get a 10% preferred return on the cash that you put in. That's the rule, right? And then after that, it's 10%. So let's say for one instant that the company, how much the entity made, what the hell is that about?
It's because you're in a training room, so it just downloaded the training.
Okay, I don't know what any of that means, but sure. So let's say instead of making $300,000 of income, this made zero taxable income. And let's just leave it there for a second. There was no ability to allocate income to anybody, correct?
Yep.
So in order to, we follow liquidation provisions to make things true, correct? But there's no income to allocate. So how much preferred return is A owed on an annual basis?
100,000.
100,000. So A was owed 100,000, but there was no income. There was zero income to support A getting that. Okay, so we get to year 2, and there's $400,000 worth of income. How much preferred return was owed to A in year 1?
100.
Did we do an income allocation to A?
No.
No. How much was owed in year 2?
100.
How much total do we owe A?
200.
200. So going to our example, we owe A 200. Correct?
Yep.
Which leaves 200 left over, correct? Which
Yes, you
is split
said
50-50.
400. Yep.
Now let's make an assumption, Brett, that our 704B and 704C capital accounts there's no inherent gain.
Okay.
Okay? So B's in capital account, 704A and 704B and C is 0 and 0. And A's is $1 million and $1 million, correct?
Yes.
Based on what we did this morning. Now we have a $400,000 income allocation. Is that preferred, or is that required or agreed? Agreed. We have an agreed upon income allocation. Now we have 400,000. So A's capital account goes up by how much?
Agreed upon.
300, correct?
So the preferred is not considered a required bucket. Okay, then 300.
It's agreed. So
Okay.
A's capital account goes up by 300 to $1.3 million, correct?
Yes.
200,000 of preferred, $100,000 of 50-50.
Yep.
B's goes up by 100,000, correct?
Yep.
So now there's $400,000 sitting in the bank account. The partnership says, well, we got to follow those rules. So first thing we're going to distribute is preferred. How much preferred does A have?
200.
200. So 200 of the 400 goes to A as a distribution. A's capital account goes from $1.3 million to
$1,000,001.
$1.1 million. So now A is in $1.1 million, as B is 100. And we're going to say the rest goes 50-50 because that's what the rule is here. So now we're going to distribute 50-50. We've got 200 left over in the account. How much goes to A?
100.
100. How much goes to B?
100.
So B's ending capital account is,
0.
A's is
Million.
$1 million. So that amount that's being distributed is all predicated on an income allocation going to A or to A and B. Okay, because in year 1 we didn't make anything. So now in real estate entities, and what makes real estate entities difficult with preferred return is, and this is where attorneys need to be very precise, and what they mean in the agreement is, we're going to first require a distribution of preferred return, then preferred capital, so on and so forth. The real estate entity loses $100,000 from a tax perspective because of interest, depreciation, and maybe some other non-cash items. So now we have a $100,000 loss. Do we have any income to allocate?
No.
Okay, so our rules are, it goes first to preferred, right?
Yep.
Then to preferred return, then to preferred, then to common. So the thing about a waterfall is you gotta have a compass. You have to have a memory. You have to know where you're standing in that preferred return. So if we have in year 1 we have a $100,000 loss, have we ever had a preferred return that has made the capital account go up at this point?
No.
We have not. Have we ever had any common that's made the common go up?
No.
No. So the only place that loss can go is to the preferred capital. So now my preferred capital has a $100,000 loss that's jammed to it. So it goes from $1 million down to 900. Well, a real estate entity happens to have excess cash flow because it has these non-cash losses called depreciation. So now I have excess rental income, and now I have $100,000 of cash. What do you do with that? Where's it go? So now this is where your question, I think, could have pivoted on. I'm not sure if it did or did not. Was the company makes a $100,000 distribution. $100,000 distribution goes to preferred return first. Have we had any preferred return income allocation to A?
No.
No. So can we distribute something that hasn't been allocated to A yet? The answer to that's no. So then we distribute preferred capital. So now my preferred capital, what's it do to that? So definitionally, when we have a distribution of preferred of dollars that are not supported by income, you need a definition in there or guardrails on what exactly that means. And the two options that I've seen most is we're not going to harm your preferred capital in that fashion. We're going to, for calculation purposes. So even though we were distributed, there's two things that just happened to your preferred capital. A $100,000 loss took your capital from $1 million to 900. That's one column. Then you had a $100,000 distribution, which took your capital from $1 million to 900 to 800. But on return capital, there's generally going to be a definition of unreturned preferred capital that says loss isn't going to harm it for calculation purposes. So the $100,000 loss is not going to harm unreturned preferred capital. And unreturned preferred capital is going to be times your percentage, 10%. So loss doesn't harm it, but distribution may or may not. So if distribution, that $100,000 cash distribution, is a harm, meaning you put in 900 or $1 million and you got 100 back in cash, there wasn't an income allocation to support it, therefore that's a harm to your undistributed preferred capital, then your undistributed capital goes from $1 million to 900, and now you apply the 10%, and now you're due $90,000 the next year because you got an amount that was in excess of what your preferred return was that harmed or reduced your unreturned preferred capital. That is a very difficult thing to pin down, especially in a real estate deal where we're constantly running break even or losses but have excess cash. That's where attorneys think in dollars, and we need to think in terms of income allocation and make sure that it's all married and make sure that those definitions work. Did that even come close to answering your question? Or was
Yeah, I think so, because I think I was stuck on the 100,000 every year is going to eventually deplete your $1 million preferred capital, but that's only going to happen in special situations where you have a loss plus distributing out.
you have to have an income allocation to support the increase in the capital account in order to have the preferred return. You have to have income. Income and loss is going to be allocated in a manner to make these true, which means that on a preferred return, you have to have an income amount or $100,000 in year one to have an amount go into that bucket. You have to have an income allocation to support that preferred return.
Without contributions, is it ever possible for that $1 million undistributed preferred capital to increase that your 10% is figured on?
Yeah, and it's called compounding. So this would be non-compounding, and I prefer non-compounding. It's simpler for me because every year I'm going to take my capital times 10%. But if it's compounding preferred return, meaning I'm in year one, I'm owed 100,000. Well, I didn't get it. So year two, I got 1.1. 1.1 is going to be 110,000 because it wasn't returned. So we're going to treat it like compound interest. It will increase under that scenario. Let's see. Disguise sales. Ah, damn it. disguise sales is what I erased right there. Makes me sad it's gone now. Which was the 2-year rule. Contribution of property by a partner to a partnership may be recharacterized where the contributing partner receives distributions of cash or other property that are in substance consideration for the contribution. So that's going back to Brad's. Actually, I truly do appreciate Brad coming up with an idea of why don't we just fall into the contribution rules, which is going to be tax deferred, right? And then have the cash do a U-turn going out the other side, which should just be a hit to basis, right? Feels like we defeated that, right? Well, again, contribution of property, of cash, inherent gain property with cash doing a U-turn within the first 2 years, that is a deemed sale of an asset. Hoffman, how many disguise sales have you seen?
0.
Bullshit. Benny?
Well, we tell them not to kick cash out for 2 years, and they always listen.
Okay, I got the smart ass row back there. That's what I got.
They were loans.
That's my favorite kind.
You get my point. It happens. Though that is just confirmation that it happens. And the thing that you need to understand is that first 2 years of cash going into the partnership, there's a rebuttable presumption. The IRS gets to assume if cash does a disproportionate distribution in the first 2 years, they're going to assume it's a sale. And if they assume it's a sale, you have the opportunity to have a rebuttable presumption that it's not a sale, and it has to be based on the facts and circumstances. The facts and circumstances have to be in your favor, and you have a loan, wink, or you hold on to the cash for 2 years and a day, right, Hoffman?
Yep.
Wink. Okay, you need to make sure that you can defend whatever it is that you're doing in terms of a disguised sale.
No, the last one I had, Pete, I had there's 3 partners, 2 of them are brothers, and one of the brothers put in property, and talking to both of them, they both understood they couldn't kick out any cash to in an unequal amount to just the contributing brother. And
The inherent gain contributing brother.
right, and then 2 years later, the brother called me and said, "Okay, can I take my cash now?" And I had forgotten about our conversation. And he was like, "You told me I couldn't have any cash. It's been 25 months. I can get my cash now, right?"
Thank you for not sending me an email and calling. That's what that conversation would be. But here's how this kind of manifests itself or pops out as a problem is if I have something worth $1.5 million, Ben has something worth $500,000, and John is putting in $500,000 of cash, and we agree that it's going to be a third, and a third in terms of our equity interest. Well, I put in $1 million worth of stuff. And waiting 2 years, somebody that's going to connect the dots, and now I'm getting $500,000 2 years later, which my amount now went from an equity value of $1 million down to $500,000. That stuff can get sniffed out. So you're waiting and sitting on the cash. You have to be able to explain why that economic disproportionality existed and defend it. Okay. Nate, who you want to call on?
We'll call on Burton.
no, I get the afternoons off.
I'm only good for the morning.
Who you want to call on? I give Burton and Hoffman the ejection.
Oh, we'll do Alyssa.
All right, disguised sale. So facts. A owns land worth $1 million with a tax basis of 100,000. B has 500,000 in cash. A and B form AB LLC, where A contributes the land and B contributes the cash, $500,000 cash. Immediately after AB LLC is formed. AB LLC to A formation. Okay, so what is A's gain and the character of the gain?
When A contributed land, B contributed cash. Immediately after AB is formed, AB LLC. Swear to God, I just get distracted so fucking easy. AB, I bet, distributes the 500,000 of cash out to A, because
Okay.
there is no cash on the balance sheet, is there?
No.
And A's equity happens to be 500. So I not only make you guess at what the answer is, sometimes I make you guess at what the question is. Okay? So what are the questions here, Alyssa?
Okay, so we have what is A's gain and the character of the gain? Do you want me to keep reading all of them or
Well, let's answer. What is
Okay,
A's-
what is A's gain and the character of the gain? Okay, is the gain the 900,000?
How much?
900,000?
How much cash did they receive?
Oh, 500,000.
Okay. So proportionally, 500 to the overall fair market value is what?
50%.
50%. So in the same way on 99.5, where we bifurcated or allocated Jim's basis on the ground, don't you think that would be the same here?
Yeah.
Okay, so what is A's gain?
So 500,000.
Well, how much
Or
basis?
400,000. Right, there's a basis of 100,000 and
Sam, you want to help her? That's what that was. That was math Tourette's. How much basis does A have in the ground?
100,000.
How much was sold?
50%.
Half of it.
So how much basis do I get to use?
50,000.
So how much proceeds did I have? An actual light bulb went ding over your head.
Yeah. Okay, so 500,000.
How much is my basis?
50.
What's the gain?
450.
Yes. Okay. What's the
Cool.
character?
Don't know.
It depends.
It depends. What's it depend on?
How much they held the ground.
Do
No,
I?
what A was doing with the land. How they
You know,
held
for
it.
two
Oh,
guys,
yes.
two guys that taking the afternoon off, they're coming in
I
hard.
think
Yeah.
Burton did want the
I'm trying to
question.
get this fucker over.
Depends on what they're intending to do with the land.
No, it depends on how A held the land.
Okay.
Was it inventory in A's hand? Was it 1231 or was it capital? Okay, what's 2 say?
All right. What is A's basis in the AB LLC partnership interest? So, I don't know.
Who you want to ask?
Sam.
Sorry.
Yep.
So it started with 100.
Yep.
So 50.
50. Does that make sense, Alyssa?
Yeah.
Okay.
Sure.
Okay, so what's the third question say?
What is AB LLC's basis in the land?
And what is that?
50? I don't know. I'm honestly kind of confused right now. You can't tell.
Okay. Calling somebody.
Leslie.
Okay, so what is ABLC's basis in the land? Mm-hmm. So it owns land worth $1 million with a tax basis of 100,000. Value. I would think when A contributed, would the basis get carried over the 100K?
What about the gain loss that A experienced?
That is true. So A experienced a 450K gain.
And what were the proceeds?
500K.
Okay, does this feel remotely anything like 99.5?
Yes.
So what is it? What do you think AB's basis is going to be?
So AB's basis is going to be, isn't it? I gotta go back. Was it the fair market value plus the gain?
The fair market value plus gain. Yes. Well, fair market value plus carryover basis might be a better way of saying that.
Okay, fair market value plus carryover basis.
And how much would that be? Because if we go back to that rolled and sold, remember we had the basis. Remember how we had on the purchase piece, we went to the purchaser's fair market value column,
Yes.
and then we went to the carryover basis of the contributor to come out to what in this case would be AB's basis. So the fair market value of the purchaser, how much did the purchaser pay?
A would have purchased it.
A would have been the seller.
Oh, so you're saying how much B would have purchased it for?
Yeah.
Or $1 million, since that's the fair market value.
Nope, 500. How much cash came out?
Oh, 500.
Okay. So now we're back to this proportionality, right?
Yes. So you're saying like 50-50.
Yes. So, but A had land of $1 million, basis of 100, correct?
Yes.
Okay. B came with cash.
Yes.
Okay. So let me ask this question. Where? Go ahead.
Oh, so, no, you go ahead.
It looked like you actually had an aha.
Well, yes, but you can go ahead.
You don't want to take the risk, do you?
No, I was to say, okay, so B contributed the 500 cash, so then we're saying that the land is worth 500 if we're doing 50-50, right, for fair market value?
Nope.
Okay.
Okay, so let's do it this way. When the dust settles, let's go at it this way for a second. When the dust settles, what's the balance sheet of AB?
After the sale.
After the dust settles. Yep.
Okay, so up there we have land.
Is there any cash in the partnership?
No, because they distributed it out to A, which was then the sale.
Okay. So then the equity is 500 and 500, and this is on evidently a fair market value balance sheet.
Okay.
Okay, but there's no cash that's there, correct?
Yes.
Who ended up with the cash?
A.
Okay, so A came with $1 million of fair value, correct?
Yes.
But ended at 500,000 of fair value because A harvested out 500,000, correct?
Yes.
Okay, so let's put a pin in that for just 1 second. What if B paid A $500,000 for half their land?
That would be a gain.
On the sale or exchange of ground.
Yes.
And then what if A and B then took their pieces of ground and shoved it in a partnership?
That's no gain or loss.
No gain or loss. Okay, but B's basis in the purchase ground is how much?
So B's half 500,000.
And what's A's basis?
500,000.
Nope. Started at $1 million of basis, $1 million of value, and 100,000 of basis. How much was sold?
50.
50%. So we were able to use 50% of the basis, correct?
Yes.
To arrive at the 450 of gain.
Yes.
Okay, so if we arrived at the 450 of gain, We use 50 basis. How much basis is left behind?
So if we use,
Started at 100,
okay,
used 50.
so you're saying started at 100K, oh, use 50, so we're at 50.
Correct. So now A has a piece of ground worth 500 because it didn't sell that. It sold
Okay.
half at 500 with basis of 50.
Yes.
Now, if we stuff those into a partnership, A's basis in the ground is 50.
Yes.
B's basis by virtue of the purchase is 500.
Okay.
Correct?
Yes.
Is everybody with me? Okay. How the disguised sale is no different than that.
Okay.
Even though the cash went in and did a U-turn, you have to say B bought something. A sold something. What did A buy and what did A sell and what did B buy? And then once you figure out what A sold and B purchased, you're able to now assign tax basis no different or substantially the same as this here, is 99.5. Does that make sense?
Yes, but I mean, I would go over it again if you want to.
Let's do it again. And actually, why don't we just change the facts since if we're going to do this. And maybe let's even try to see if we can come up with a procedure on how to think about this. Maybe. I've never done that before. But let's see if we can. Okay. You have A with land of 2 million, basis in the ground of 1 million. B has cash of 1 million. The facts are B contributed the 1 million in exchange for units. And A contributed land for units. Then, 2, the partnership distributes 1 million of cash to A and nothing to B. So, what's my balance sheet when this happens? And let's just deal in fair market value for now. My fair market value before the distribution, do I have cash, Leslie?
Yes, of 1 million.
Cash of 1 million. Do I have land?
Yes.
How much?
It says the land is 2 million.
Okay. Equity?
3 million.
To whom?
It would be B is 1 million, A is 2 million.
Okay. Then we come over here. We have fair market value. Do I have any cash?
So the 1 million cash got distributed to A.
So now
Right.
it's 0.
Okay.
Land?
Land is still 2 million.
Okay. Equity?
Equity would have to be 2 million.
By whom?
A. Oh wait. So. Okay, this is where I got confused. So.
Who received the cash?
A did.
So A started at what?
Oh, okay. So A started at 2 million, so then it would be 1 million and 1 million.
This is 50-50 relationship, correct?
Yes. So I feel like from the start where I got confused is, I mean, we had the fair market value of the land, but we say like if we don't, we just assume what it's the cash we put in. So like, you know, you put in cash of 1 million, so then you would kind of assume the land you put in is 1 million. But it's not because we have the fair market value of the land.
Okay, so you're using what we were a tool earlier, we were inferring value based on the cash that's coming in.
Yes.
Okay, that's not an unreasonable thought process, and that's not an unreasonable thought process that is misapplied in this case, because the cash, that's a perfect line to have been drawn from the standpoint of that's what we did earlier. You gave me a rule that says cash should infer the value, overall value, and we're saying A and B are partners in the partnership, and you're saying $1 million of cash came in, and that $1 million of cash for 50% would mean the value of the land is $1 million. Completely reasonable, but in this case, you have to, unfortunately, push that thought process aside and say, well, wait a minute. If we started out at $2 million, because, well, this is why we can maybe push this aside. So A's balance sheet, pre-transaction. Okay, if you're going to tell me transaction. If you're going to tell me A's balance sheet, Leslie, pre-transaction, what in fair value is A's balance sheet in terms of asset and equity?
I mean, if all they have is land
Uh-huh.
for fair market value, we had 2 million land, 2 million equity.
Okay. So post-transaction, what is A's balance sheet?
0 and 0 if they contributed at all to AB.
Huh?
I mean, A personally or
Yeah, A personally. What's A have post?
0 because
LLC.
oh, you're saying what does the LLC have?
No, A. What
Oh,
does A
A.
own?
Oh, the LLC.
Okay, well, but did they get something?
They got the 1 million distribution.
So A now has cash, correct?
Yes.
Of 1 million. Okay? And we're 50-50. How much does A own of the LLC?
1 million.
1 million. Correct?
Yeah.
So we have 2 million of value here and 2 million of value here, correct?
Mhm.
So your indice of value saying, well, 1 million went in, therefore the land has to be 1 million, doesn't work here because I still have 2 million of value in A's pocket. So what you have to do in a disguised sale, I guess this is what I would do, or how I would view it, is, well, wait a minute. A has 2 million of land, basis of 1 million. B has cash. And at the end of the day, when the dust settles, the fair market value balance sheet says there's 0 cash, land only, and it's a 50-50 relationship. So what has to happen in order for me to get point A to point B if it were not washed through the partnership? What would have to happen that gets cash of 1 million in A's pocket and LLC interest? So when the dust settles, B started with 1 million of cash, correct?
Mm-hmm.
And B ended with, this is A, and B ended with LLC of 1 million. Correct?
Yep.
So the partnership only has land of 2 million when the dust settles.
Mm-hmm.
So B, this infers, and this is hard, I don't know, I have to formulate a better way of explaining this. B had to have purchased $1 million worth of land when the dust settles, and then contributed it. That is one way of thinking about it, because at the end of the day, if you turned off all this noise and B said, hey, A, I'm going to give you 1 million of cash and you're going to give me 1 million of ground. Okay? If you just look at A only, okay? A has 1 million of cash and 1 million of LLC interest.
Mm-hmm.
Because A converted a portion of their interest, their land, into cash. And B, if that's true, now has 1 million of land. And B has basis in that ground of $1 million. Okay, so you almost have to push, I guess, for me, I don't have to do this, but I'm struggling with a good way to get from point A to point B to say that I'm going to turn off the partnership agreement and say, or partnership formation. What happened? Who bought what before everything got stuffed in there? Because the cash did a U-turn coming out. And the cash did a U-turn coming out was a sale or exchange basically at the partner level before it got stuffed in. Maybe. Hoppin, Ben, you guys got a better way of doing that?
I'm trying to think through your 704C capital accounts. On the, you go contribution. So each of them contribute $1 million, right? Because we said basis was $1 million in the land and cash is $1 million.
They contributed half the land.
Well, now the mechanics of this, Ben, I have no idea what truly the mechanics are. Because am I a big fan of shortcutting?
No?
I hate shortcutting.
Then you're shortcutting the shit out of this.
I think I am, actually. I mean, I've never realized that's what I'm doing, but I really think that might be what I'm doing, is shortcutting this without realizing that's what I'm doing.
Because I think this is one of those tax fiction deals where it's like, okay, from a legal standpoint, I threw in land, you threw in cash, and then I took cash out, and we got to our position of, our equity's 50-50, and the entity has land. But from a tax standpoint, I sold you the ground, and you paid me cash, and we both contributed land to the LLC. Because when I
think that's exactly right.
Because when I try to do the capital accounts, I don't think I can get the math to work.
Well, I'm saying that there's 50 left over, correct?
Right.
And, well, no, hold on, excuse me. Yeah. So I got basis of, I got $1 million of proceeds, correct? A sale, proceeds, basis, 500K, 500K gain, right? Because this is 50% of what's happening based on the proceeds. Okay, so A's sale, B's basis, 1 million. Okay, so now I know I push the cash aside because the cash isn't going to reside there. That's not a contributed asset. So A's basis is 500,000 in the remaining piece. B's basis is $1 million. So I have 1.5 million, 0. A's basis is 500. B's is $1 million. 1.5, 1.5, 500K of gain to A, 0, 500K gain still residing in that land. This is how I think that works. And I think you're right, Ben. I think mentally I am shortcutting this somehow. And mentally I'm not, generally I can take the steps and be able to say, this is what's happening at each individual step. I don't think I'm failing miserably in this moment, but there's some failure here and I don't know how to correct the failure.
The only other way, like if you have the contribution and it's an actual contribution and a distribution back out, then your basis is 0.
That one,
Yeah.
yeah. Assuming you get out of the disguised sale rules.
Yeah. That's why it's important to convey there that ordering of what happens in that transaction. Because if you just go down the route I did, even though you're still picking up the gain, you could end up with you'd have your basis screwed up. So otherwise, you have zero basis because I've taken the money out. Yes, I have a gain for my sale transaction, but if I just say I put in $1 million of basis, took out $1 million of basis, I have zero.
You double dipped on yourself.
Yes.
That's true.
Yeah,
Yeah, that would be bad.
yeah.
That'd be bad planning.
That's
that,
why
would- that would not be Hoffman planning.
No.
Hoffman planning generally would be
He'd
negative
have double the
AMT.
basis.
Exactly. Exactly.
He'd have a loan of $1 million.
Oh, that now it makes sense. You just put the loan on and it works.
Oh, look at that. 4 o'clock, last page, we're out.